Hi, this is Julia M. Spencer. I'm a real estate advisor, investor, and your number one source for real estate advice online. Thank you for tuning into my channel and listening to my videos. Feel free to share them, put them on your Facebook, your social media if you find them useful, and make sure you give me some comments on if you like the information that you get here. By the way, I am a real estate investor. I'm a single mom of two, and I love my work. Actually, I pretty much just work from home most of the time and do all kinds of fun stuff with my kids. So you can have this life also if you decide to get into real estate. And this video, we're going to explore the wonderful world of capital gains and how do we avoid them. And actually, we're going to talk a little bit about what capital gains even are, because if you're a real estate investor, you're going to need to know what capital gains are, and you're going to try to steer clear of them as much as you can. And how do you do that? So let's get right into the topic. By the way, my email address is realestate@juliamspencer.com. My website right at the bottom of this video. You can go there, subscribe to my newsletter. Actually, make sure you don't forget to do that today. And I published a number of ebooks also on all kinds of real estate topics. I am always looking for feedback and information from you all, my great subscribers, with questions and information that you want to know more about, because that helps me create my ebooks and my videos. So let's get back to the topic of capital gains. Capital gains, what is that? If you own your own home and you're just kind of living in your own home, or if you're a tenant, capital gains doesn't mean much to you. In fact, you probably never heard of it. But if you are a real estate investor, capital gains can be a major pain in the neck for you. And let me just tell you what capital gains are. Capital gains is that amount of money that you have to claim on your tax return if you make a profit on a sale of a property, an investment property, and that's what you have to pay taxes on. And so because we want to avoid paying taxes as much as possible, or at least minimize it, we don't want to avoid it, obviously we can't, we got to pay taxes eventually, but you want to be smart about this, so you want to reduce your capital gains, and that way you don't owe the IRS as much money as you would normally. So how do you avoid capital gains, and specifically capital gains taxes, if you're a real estate investor? Here are a couple of ways. Way number one, you can basically do a 1031 exchange. What is a 1031 exchange? Well, 1031 exchange, and don't even bother with the number because it doesn't mean much, it's just the code, an IRS tax code. It basically says that if you're a real estate investor and you sell your property and you basically make a profit on the sale, and that's a whole nother topic, but if you make a profit on that sale, you normally would have to pay taxes on that profit at whatever tax rate that you are at the moment, or that year when you file. But with the 1031 exchange, if as long within a certain time frame you decide to use that money that you made from profit to turn around and purchase another property with for real estate investment, guess what? You don't have to pay capital gains, because essentially you're not selling and buying, you're exchanging from one property to the other. And there's a couple of stipulations with this. First off, you can't actually hold the money from the sale, and you can't have the money to hold to buy your next property. What happens usually though is you ask your real estate agent and whoever does the transaction for you, usually your attorney, to tell them basically that you want to do 1031 exchange. There is a fee, an extra transfer fee that you probably have to pay on top of your attorney costs in order to do that transaction. But what they basically will do is they will take the profit, the proceeds from your sale of your property, and put it in a sort of a trust account. And then within a certain time frame, you'll have to identify the next property that you want to buy. And that has to be, I think, within 30 days or so. And then the sale has to happen within 90 days, I believe. Verify that with an attorney, because that may be different in different states. So within that 90-day time frame, you're going to have sold one and purchased the other, and then your attorney who holds that money in the trust account will take that money to use as a down payment or a payment to the next purchase that you're doing. So in that case, as long as you're using that entire amount in that trust account, it is not taxed. Now let's say you made a profit of $100,000 on a 1031 exchange. So the money is sitting in this trust account, this $100,000. You want to buy another property for $100,000, but you only want to use about $30,000 of that trust account money to put down on the next property. So you would be using out of your trust account $30,000 for the next purchase and take the other $70,000 out to use for whatever else. Well, you're going to be taxed on that $70,000. The $30,000 that you use for your next purchase is going to be not taxed. And that's just kind of rolls over to the next property that you buy. So obviously, if you're going to do a 1031 exchange, kind of count with the fact to use most everything in your trust account, or else it's not, there's no purpose for you to do a 1031 exchange. So that's one way to avoid capital gains taxes. And I want to just add a little bit of a correction, because you actually have 45 days of the sale of the original property to identify other properties that you would like to acquire, and then you have to complete the entire process within 180 days of the sale. There is a 1031 facilitator fee, and it's usually around $750. Another way to avoid capital gains taxes is capital gains taxes really only apply to investment property. So what I've seen a lot of people do, I haven't done this myself, but the IRS code basically says that if you own the property and you actually live in it for 2 years out of the last 5 years, then it's considered as one of your residences, and you potentially would not have to pay any capital gains taxes. Again, make sure you verify that with a CPA, with an attorney, with a tax professional. I am neither one of those three. I'm just telling you what I know from experience, from over 20 years, 25 years of real estate investment experience. So basically, if you live in a home for 2 out of the last 5 years, and you sell that property, you may be exempt from capital gains taxes. Again, verify all that information with the professionals. That's way number 2 of how to avoid capital gains taxes. Here's another way to not maybe avoid capital gains taxes, but maybe reduce them or spread them out over a long period of time. So here's the third way that I try to actually go about avoiding capital gains. It's basically the sale by assignment or agreement of sale. So it's kind of like a lease purchase option, but you're basically selling the property on a contract to a tenant, and you basically tell them that you are obligated to pay these payments for this amount of time, and if you and basically when you finish paying all the payments, then I'll give you the deed. So if you don't need all the money right away, you can do agreement for sale. So check your state statutes, read subsequent forfeitures. There's basically you only pay taxes when you get the funds, and rather than going through a lengthy foreclosure on a deed of trust, if the buyer does not perform, you can do an administrative forfeiture, and you have to check the laws in your state about that. In some states it's pretty fast and cheap, in other states it takes a little bit longer. So the other advantage of an agreement like that is that you can often get more money for the sale. So you can basically, the owner, if the property is improved or has a building on it, rather than paying rent, the owners may choose to purchase a property with an agreement of sale and make monthly payments instead of renting. And they might be not as sensitive to a high price when they don't have to come up with the funding all at once. And so you can also use that agreement, once you have it, as a collateral to borrow money, or you can assign it to somebody else for cash. So yeah, that's another way to not have to pay your capital gains taxes, at least not right away. And hopefully all of this makes sense to you. If it didn't make sense to you, send me messages, realestate@juliamspencer.com. I'm actually right in the middle of trying that last option of assignment or agreement for sale, and then assign that sales document to somebody else for a cash monetary reward. And hopefully I see you investing very successfully soon. Make sure you write me and subscribe and go to my website at juliamspencer.com, and I'll look forward to hear from you. Thank you.
For your free guide to real estate investing, visit juliamspencer.com.